You look at the news these days, and it really feels like the economy is just pulling itself apart.
Right, it does, doesn't it?
On one hand, you've got these asset valuations hitting levels that seem, well, completely detached from reality. Record highs,
Hmm.
driven almost entirely by this just breakneck race, uh, billions and billions pouring into AI infrastructure.
Yeah, that tension, that feeling of extremes, that's exactly what we're digging into today. We've pulled together a whole stack of sources,
Mhm.
and they paint this picture of, well, massive corporate concentration, huge investment.
Unprecedented levels.
Right. And this is the key part, it's happening while regulators are ramping up scrutiny. And maybe the most fascinating bit, individual investors like you are shifting how they think about risk, about the future. There's this growing skepticism.
Okay, so that's the mission then. How sustainable is this hyper-concentrated environment? And what are the maybe surprising ways all this pressure is showing up? For big tech, sure, but also for governments, for you as consumer, and especially for this new generation of investors who feel, well, kind of left out.
Exactly. We need to get a handle on the forces building the future versus, the friction that's happening right now.
Okay, let's unpack this then, starting right at the very top. The AI build-out. It's monumental.
Truly is.
I mean, when you talk about spending that genuinely changes the global market, the absolute centerpiece has to be that NVIDIA and OpenAI deal. $100 billion. It's
Wow.
not just the number, though. It's the confidence, or maybe arrogance. We know the CEOs, Altman and Huang, they supposedly hammered this out one-on-one.
Yeah, no bankers involved, apparently.
Right, just the two of them. That says something.
It really does. The sheer scale of that kind of backroom deal
Mhm.
signals the power these two companies now wield. And look how the market reacted. Instantly.
NVIDIA's valuation just shot up. Nearly what, 4.5 trillion?
Almost. And it wasn't just NVIDIA, was it? It lifted everything. S&P 500, NASDAQ, Dow, all hitting new records.
Even internationally, you saw Taiwan's index, the TAIEX, jump to a record high. It shows how this ambition is moving global capital. It's huge.
And it's not just one data center they're talking about here.
No, no, this is part of something bigger. They're calling the Stargate project. The goal is these massive 10 gigawatt AI supercomputing sites.
10 gigawatts. That's like small city levels of power.
Exactly. And the funding is aggressive too. That first $10 billion chunk locked in at a $500 billion valuation for OpenAI.
Half a trillion.
And what really struck me from the sources, OpenAI is planning to take on serious debt for this. They're even thinking about becoming their own cloud provider.
A first-party cloud provider.
Yeah, essentially building their own utility because apparently what exists now just isn't big enough for what they want to do.
Well, needing to take on debt really underlines the massive cost here. We're talking about hyperscaler capex. That's the money giants like Microsoft, Amazon, Google spend on their server farms.
Right.
And while some experts, Gene Munster was mentioned, think this AI hardware build-out will last longer than maybe people thought, there are real questions about sustainability. Can these companies keep spending at this rate?
And that concentration you mentioned earlier,
Mhm.
that's a massive risk too, isn't it? NVIDIA's making trillions. Fantastic for them. But if only a handful of hyperscalers are buying these chips in huge quantities.
NVIDIA gets very reliant on a tiny customer base.
Hmm.
Huge concentration risk for them.
Yeah.
Precisely. And then you connect that to the bigger picture. The resource limits, they're starting to look enormous.
10 gigawatt sites.
Exactly. Investors are starting to ask, seriously, is there actually enough energy capacity globally to power this vision?
It's not just a theoretical question anymore.
No, not at all. You're already seeing it move markets. Power-related stocks like Constellation Energy, Vistra Energy, they're up because people see them benefiting directly from this insane demand for electricity.
And layered on top of the energy crunch, you've got the whole geopolitical mess.
And the supply chain.
That resource constraint feeds right into another huge systemic risk. Our sources flag geopolitics. It was interesting to see China's electric vehicle giant, BYD.
Yeah, they use NVIDIA's auto chips, the Drive AGX Orin system.
Right, and they publicly stated they have a backup plan, just in case U.S.-China tensions cut them off from NVIDIA.
Their focus on developing tech in-house, it's basically their insurance policy. Smart, given the climate.
Okay, so let's shift gears a bit. We've talked about building the future, these massive, risky, expensive projects. But what about how big tech manages its current, cash cows? That's where things get really interesting with friction, scrutiny.
Exactly. While they're planning Stargates, some of their most profitable existing businesses are under intense fire. Regulators, the public. Look at Amazon Prime.
Yeah, that FTC lawsuit from 2023. The claim is Amazon tricked and trapped millions of people into signing up.
And the internal details that came out, pretty damning.
Staggering, really. The sources said Amazon employees internally called the sign-up confusion. You know, where people didn't realize they were subscribing an unspoken cancer.
Oof.
But the cancellation process, that's where it gets almost comical if it weren't so frustrating for consumers.
They actually nicknamed it the Iliad?
The Iliad. Because it was this epic struggle, apparently. You had to click through 4 different web pages, choose from 15 different options, just to cancel.
15 options.
It's wild. And this trial, starting this week in Seattle, it's kind of the main event for the FTC's crackdown on these dark patterns.
Right. And for listeners, dark patterns, it's just a term for these, well, deceptive design tricks. Built into websites or apps, they fool you into signing up, or they make it incredibly difficult to cancel.
Like the Iliad.
Exactly.
Kind of.
And the FTC already scored a point here. A judge ruled Amazon did violate ROCA, that's the Restore Online Shoppers Confidence Act, specifically about making billing clear.
So regulators are really pushing back now, directly challenging how these profitable subscription models are built on, well, friction.
It's a big shift.
Yeah.
And you see this pressure forcing companies to rethink things elsewhere, too. Look at Amazon again. They're pulling back on their physical grocery stores, the fresh stores.
Closing all 19 in the UK, focusing back on online delivery, even though the CEO, Andy Jassy, says he's still bullish on grocery.
They're trimming the physical side, focusing on digital. Makes sense.
But then contrast that with pharma. Eli Lilly is doing the complete opposite.
Doubling down on physical. Big time.
Yeah, a massive $6.5 billion factory planned for Houston, Texas. Heavy, expensive, U.S.-based manufacturing.
And it's very targeted spending. It's to boost production of what they call small molecule drugs. Crucially, their experimental obesity pill, or for Glipron.
They had supply problems before, right? So this is about capacity.
Exactly. And it fits into this broader trend we're seeing reshoring.
Yeah.
Bringing manufacturing back to the U.S., which, has been bubbling up, partly influenced by things like former President Trump's talk about tariffs on imported drugs.
So much corporate friction, and it spills over into media, too. Disney's raising prices again.
Yep. Starting October 21st, the ad-supported Disney Plus goes up $2 to $11.99 a month. The premium, no ads version, jumps $3 to $18.99.
Ouch. And this hike comes right in the middle of that whole controversy involving political commentary, right?
Yeah. The Jimmy Kimmel situation, yeah.
Yeah.
It's a perfect storm, really, showing how corporate distribution itself is becoming politicized.
ABC pulled his show, Jimmy Kimmel Live, after comments about the alleged killer of Charlie Kirk, the conservative activist. But what happened next really shows how fragile centralized media can be.
Major station groups Nexstar, Sinclair, they refused to air Kimmel's return show.
They said they needed a commitment to respectful, constructive dialogue.
Which, sounds reasonable. But in this context,
It's loaded. And then it got even more intense when the FCC chair, Brendan Carr, hinted that broadcast licenses might even be at risk if stations don't meet their public interest duties.
wow. So the pricing power, the distribution power, it all becomes a political football.
Exactly. The price hike for you, the consumer, almost becomes secondary to this friction over political messaging and corporate control.
Okay, so let's zoom out from the corporate friction to the bigger picture. How are investors actually processing all this? This weird mix of sky-high valuations and all this risk.
Well, after the Fed cut rates recently, Fed Chair Jerome Powell himself said equity prices look fairly highly valued by a lot of measures.
Which is Fed speak for things look pretty expensive.
Right. Very polite. And former Dallas Fed President Richard Fisher echoed that, saying valuations are very strong and concentrated. He tied it right back to the dominance of those few big tech winners we were just talking about.
And that concentration is the inherent risk, isn't it?
Real-
Plus, you have Fed Governor Michelle Bowman warning the Fed might already be behind the curve on tackling a weakening job market. She wants more easing.
So the official picture is high valuations, but maybe a shaky economic foundation underneath. It requires very careful handling.
That dichotomy, the super high market versus this underlying economic anxiety, it seems to be driving a really fascinating, maybe even aggressive reaction from individual investors, especially younger adults.
Yeah, our sources point to this rise of what's being called financial nihilism.
Sounds dramatic, I know. But it seems rooted in reality for a lot of people. A Columbia Business School professor called it a rational response to a pretty bleak outlook.
You look at soaring house prices, crippling debt, a job market that feels tighter. The traditional American dream path just feels
Out of reach. impossible for many.
So if that old path, save slowly, buy a house, invest safely, feels blocked, what's left? The rational choice
Swing for the fences, go for broke.
and that's what we're seeing, right? People piling into high-risk stuff, crypto, volatile meme stocks, the sorts that mentioned Open Door, Kohl's specifically.
And leveraged ETFs. There's been a record number of those launched this year. For listeners, these basically use debt to amplify returns, which means they also amplify risk. Huge swings.
It's the ultimate gamble. The sources even highlighted a 25-year-old sports bettor, Jacob Kaplan. He sees taking these massive risks as his only real path to getting any kind of financial security.
It's a total rejection of the old slow and steady wins the race idea, because the race feels rigged.
But then you have the complete opposite trade doing incredibly well, too.
The safety trade, gold.
Yeah, gold has surged, up over 40% this year, hitting record highs over $3,700 an ounce.
Driven by those low rates we mentioned, plus all the geopolitical uncertainty, makes tangible assets look good.
So if you're listening and thinking about hedging against all this uncertainty, what's the smart way to approach gold? You don't want to go all in, presumably.
No, definitely not. Experts usually advise keeping it small, like less than 3% of your total portfolio. And critically, the suggestion is usually to get that exposure through ETFs backed by actual bullion, things like GLD or IAU.
Rather than buying physical gold bars or coins or mining stocks.
Exactly. The ETFs are just much more liquid, easier to trade, and they track the gold price more directly than, say, mining company stocks, which have their own business risks. It's a cleaner hedge.
Okay, so wrapping this all up, the picture that emerges is pretty stark, isn't it? You've got this tiny group of tech giants in an incredibly expensive race to build the AI future, hundreds of billions of dollars.
While at the same time, established players like Amazon, Disney, they're being forced to rethink how they treat consumers because of intense pressure from regulators, from the public.
In this environment, this contrast between the hyper-expensive, concentrated future and the friction of the present, it's changing how a whole generation thinks about investing, about their future.
Yeah, the sources really highlight the staggering capital needed for growth in the 21st century. But they also serve as a reminder, don't they? That old saying, power, especially when it gets too concentrated, always attracts scrutiny. Whether it's the FTC looking at dark patterns or just the average investor feeling completely left behind.
That OpenAI-NVIDIA deal, it's being called a watershed moment. Capital and influence consolidating faster than maybe ever before. So here's the thought to leave you with. You have this massive concentration happening for the next wave of infrastructure, these Stargate projects, owned by the same few powerful players.
Who are simultaneously being sued by consumers for deceptive practices in their current businesses.
Right. So what does success even look like when the very foundation of the future is being built on such an intensely concentrated and maybe even distrusted base? What happens next?